Okay, well, we had an awesome introduction that it sounds like you may have missed. I told everybody how cool you are and smart you are, and and I think they're ready to hear what you have to say.
Great. Thanks, Kevin. Hi, everybody. Sorry about the technical difficulties. And I appreciate you being here today. And one of the reasons why I think it's really fun for me, at least, to do webinars with Pine Financial is because they're such good educators themselves. And so they give me a little bit of free reign to get into some of the details that you may not hear on a regular broadcast or in a class or even a phone call. So we're going to talk a little bit about the landscape of taxes and IRAs and real estate and the way they all kind of go together. Then I'm going to talk about some specific techniques and thoughts about the strategies that you can use that may come into play with the way that you would invest your IRA in real estate. And so I'm sure Kevin encouraged you to ask questions. I will do that as well, and away we go. At New Direction, we don't give any tax, legal, or investment advice. All this stuff I'm going to tell you today is for education purposes only. We don't sell any assets. We don't advocate any particular investment strategy or vendor. And we certainly encourage you to talk to your financial team whenever you're considering any type of investment, whether that's, a trusted friend or a CPA, CFP attorney. Really, when it comes down to it, the investment choices that you're making here are, and our role in the equation is really to just make sure that they're documented properly so that you get to keep the tax advantages that we're going to talk about today. So the IRS could, ask for the paperwork and see where all the money came from and make sure that you keep the tax advantages. And in terms of a total retirement picture, one of the interesting things that, I get very focused on IRAs because I do it all day, every day, but it really is just one of the tools. So as we start to form our map here, a total retirement picture could have a lot of elements to it, and this is only even a few of them. So whatever your personal investments are, insurance, and that certainly ties into your health as well, family resources, if you're still working or not, or when you're going to retire. And the newest tool kind of on the horizon has been the HSA, which helps with your medical expenses, and it can help your medical expenses for a lifetime. One of the thoughts that I hear a lot from our IRA investors is that they have an IRA going and they're investing it, but part of the reason that they're doing that is because they think they're going to need that for their medical expenses when they get older. And certainly that's a viable strategy. And HSAs actually help because it can help you to put away money for medical expenses later on in your life. So that's one tool that you have at your disposal if you have a high deductible health plan right now. And knowing about self-directed IRAs and IRAs themselves, of course, but typically self-directed IRAs has two benefits. One is obviously your own tax-advantaged accounts, so whether that's a traditional or a Roth. If you're self-employed, maybe you have a SEP IRA or a solo 401k. Again, you might have an HSA that invests very similar to IRAs. So all of those tax-advantaged accounts that you may have can be self-directed, and our focus today is going to be on real estate, but there are other things as well. The other thing that I like to mention to everybody, especially real estate investors, is of course that this pot of money that is somebody's IRA, whether it's a traditional or a Roth or SEP or any of those, is investable in your deals. So if you are an active real estate investor and you're looking for investors, you might mention to the people that you already deal with that their IRA could be an investor as well. So the person could invest with their personal finances as well as with their IRA. And so chances are they don't know that it's possible, and so you might get a little bit of an incredulous look when you say, hey, your IRA could be an investor. But understand that pot of money is active and it can be a real estate investor. And in a lot of cases, you don't have to create a new relationship to activate that money. You're just talking to the same person, but that person has two investable pots of money. And I mentioned this already with the accounts, but I do want to just reiterate, individual accounts are traditional IRA, Roth IRA, and HSA, but the employer accounts can also be activated, so SEP, Simple, and 401k. Typically when I talk to real estate investors, it's usually the individual accounts or a SEP or a 401k plan. But again, any of the techniques that we're talking about today can be engaged using any of these accounts, and they can all invest in real estate. So I like to, when I'm starting this map process, I like to start out at the very beginning. So why do you have an IRA? Well, I think first and foremost, most financial professionals will tell you that it's the compounding effect of having a tax advantage over time. Um, Tax deferred growth means that every time your investment makes a return, it doesn't get chipped away at by taxes. So that's a gigantic thing. Your tax bracket at distribution time may be lower than it is now, but that may not be true either. It could be higher than it is now, depending upon what the government does. So there is some speculation involved, but of course, traditional IRAs that were started in the 70s, the idea was you'll be able to contribute with pre-tax money right now. So if you're in your earning prime and your individual tax rate is as high as it's going to be, then you probably don't want any money taxed at that rate. And so because it's pre-tax money in on a traditional IRA and a SEP and most 401k plans, as well as HSAs, then that means that the tax event would happen later if there is one. And later on, if you're retired and you're not at your earning height, your best earning potential, presumably or maybe your tax bracket would be lower. So the overall gross taxation on that money will be less at a lower rate. So that's obviously part of the strategy that we're talking about. And most of the things that we're going to talk about today have some element of time to them, speculation about what tax rates are going to do and what the asset, how the asset is going to perform. In the case of a Roth, of course, one of the tools that you can use is either a conversion or contributing to a Roth. And a lot of what you're doing there is starting to eliminate speculation on your tax rate. Because a qualified distribution from a Roth is tax-free, there are several reasons why you might choose to be in a Roth over a traditional or convert from a traditional to a Roth. And so we'll talk about that as we move through the presentation. And then one of the other things is that, you know, in some cases, the total analysis and the techniques that I'm going to talk about here they're great if you can do them, but all of our lives, you know, financial lives are moving around and with a lot of moving pieces, and so there may be just small pieces that you have to take care of it one at a time. So, for instance, in a given tax year, you may need a deduction. And because when you contribute to it, a traditional IRA, or again, a SEP or a simple or 401k, you get a tax deduction, that may be the compelling factor in a given tax year. So each of the pieces of these tools, this tool that we're calling an IRA, could have a long-term calculation or a short-term calculation. And just knowing the components or the dynamics of that tool, that financial tool, is probably the best thing to do so that you can put it to its best use for you. So we talked about the reason of compounding, and this is very arbitrary and a little oversimplified, but I took $100 and I took 20 years, and I just said, okay, well, so let's say the tax rate is 25%, and if you were investing personally, you would not be able to invest the whole $100 because you just got taxed 25%, so you start off at 75. With a traditional IRA, because it's pre-tax money, you still have the whole $100, and with a Roth, because it's post-tax money, you start out at $75. And I just compounded this at 5% each year, very simple, totally arbitrary, no real reflection to the real world, other than that it illustrates what happens to the money. So in your personal finances, if you compound that at 5%, in 20 years you're at $165 and change. In a traditional, because you haven't paid any taxes on it, you're actually at $252 and change. But then that, of course, has to be taxed. And then in the Roth, because it was started out at 75, its compounding didn't go as fast, so it ends up being at 189. Now, the 189 there is actually 14% more than the personal taxes. So one of the things that's going on there is that when you take distribution, you don't have to be taxed anymore. So it's just an interesting, and so each year when the Roth makes its dividend, instead of having the 5% chipped out of it because it's tax deferred that whole time, its returns are slightly larger than you would have personally. So that tax that was being chipped away at each time didn't occur, and that's why you end up with more money in the Roth. And then as you can see in the traditional column there in the middle, I put 3 tax rates just to give you a sense of how that might work. And of course, if you were at 25%, which was our arbitrary tax rate to begin with, it all ends up as a wash, right? You end up with the exact same amount of money in a traditional as you do a Roth, because the overall tax rates that money was taxed at was the same. Now the tax deferral, meaning that once that money's in there, it's tax deferred until you take a distribution, is always going to outperform the non-tax deferred money, which is your personal. However, if you're taking into account the total tax rate, this is, again, because I oversimplified it, that may or may not turn out to be the case. There are certainly some circumstances where your personal investment may work out in your advantage, even above an IRA. So I always encourage you to run the numbers and look at the way that it plays out over time. And we're going to talk about that more as well.
Okay, Clay, before you start this slide, real quick, there's one hand raised. I'm not sure if that means that there's a question, but if you do have a question, if you could just type it into the question box, and then I can make sure I get, or I have Clay address the question. So sorry to jump in there, Clay. Go ahead.
Oh, no worries. And so again, establishing kind of our baseline of dynamics here, remember that, your IRA is a different legal and financial entity than you are. It has a different name, different bank account, different tax status. And so it is an investor that you control, but it's a different investor than you are. And I often get questions about, well, first of all, is it better to be in a traditional or a Roth? And as you saw from the previous slide, neither one of them is necessarily better than the other. It's really just a tool, and employing the right tool for the right investment is really what you want to be thinking about, not so much that one is inherently better than another. The other thing that I get a lot of confusion about and a lot of questions about is how IRA real estate investing affects your personal taxes. So I realize that this will be a little bit rudimentary, but I just want to make sure that we're all talking about the same thing. So the ways that IRAs interact with your personal taxes on a year-by-year basis is really only reflected or occurs with contributions and distributions. So in a traditional IRA, whoa, I'm going the wrong way. So contributions would affect your personal taxes because in a lot of cases you get a deduction, and so you have to reflect that on your taxes. And distributions, because that's when the tax event is, so that gross dollar amount would be part of your income for that year. Roth is a little bit different because it's post-tax money, so it might not affect your personal taxes because you don't get a deduction. And if you're taking qualified distributions, it would not affect your personal taxes because qualified distributions are tax-free. So again, these are the two. Traditional and Roth IRAs have different effects, but they're both, the contributions and distributions are the tools or the way that IRAs may affect your personal taxes. So that's really where you have to think about your personal taxes. But once the money has been contributed to the IRA, you actually can kind of let it go. Unless you're making a contribution or taking a distribution in the year, there's nothing that's going to happen in your IRA that's actually going to affect your personal taxes. So let's take this for a second. So the bottom, the little soft green there is going to be your personal financial world, and the top white part is going to be your IRA's world. So your personal finances would put some money in position. So whether that's a contribution or a rollover or a transfer, that money is now in its tax advantage state in your self-directed IRA. Now, if you took a distribution, whether that's cash or in kind, and we'll talk about that a little bit later, that might affect your personal taxes as well. So those two mechanisms, the money going into the tax advantage world and the money coming out, are the two times that you need to consider what the tax effect is. Now, while that money is in there, it can do all kinds of stuff. It can invest in all kinds of assets. So whether that's real estate or precious metals or notes or whatever it is, that's all totally independent of your personal taxes, and it's tax deferred. So one of the questions I get a lot is, well, if I invest in real estate in my IRA, doesn't that mean I don't get to take depreciation? And in a limited respect, and I'm going to get into more detail on this in a moment, that's true, but depreciation is really a deferral for your personal taxes, and you don't need it in your IRA because the entire account is tax deferred. So you actually are getting the deferral without having to take the depreciation, with the exception of UBIT, and we're going to talk about that in detail. But the thing I want to call your attention to is that the personal finances might be static, but the money and assets that are in the IRA may very well be growing. So certainly I want to make the distinction between contributions and distributions, which would affect your personal taxes, and earnings, which are all housed within that tax-deferred state. So your IRA can make $1 million in a year, and it wouldn't affect your personal taxes at all unless there was a contribution or a distribution that took place. So just keep in mind that those are different dynamics. Now we're starting to get into some of the analysis part. One of the questions I get a lot, again, I mentioned, is distinctions between types of investments or the vehicle. So people will say not only is a traditional or a Roth better, but they'll also say, should I invest in real estate in my IRA, or should I invest outside my IRA? And the answer is really that you need to ask this question of yourself first. So have you already contributed money to a tax-advantaged account? Meaning, do you have an old 401k somewhere, or a 403b, 457, 401a, thrift savings plan, all those kinds of retirement accounts, as well as a traditional or a Roth or a SEP? If you've already been contributing to them, to some extent, your analysis is going to be different than if you haven't. So if you're at ground zero and you're deciding, okay, should I put money into an IRA first before I start investing, that's a different analysis than it is if you have already been making the contributions and then you're at a point that's kind of halfway down the road. So if your answer to that is no, if you're starting at ground zero, should I invest in real estate in my IRA or should I not? One of the most powerful tools that I've seen our account holders use is this total gross tax analysis, and that's an informal word. It's not an industry term. And it takes some creativity and some speculation, and I've certainly seen people run these numbers with their CPA or their bookkeeper. But you actually think about, okay, what kind of asset are you thinking about investing in? Pick a time period, whether that's 5 years or 10 years or 20 years or whatever it is. And again, it can be kind of arbitrary. You're going to have to make some predictions about the performance of that asset, what the rental returns would be, if there's appreciation, so on and so forth, and whether tax rates are going to change. And then you assign some estimated taxes to it. So, and if you go back to that 3-column chart with the personal, traditional, and Roth, you might run it for all and just say, okay, if I'm going to buy a single-family residential and I'm going to rent it for 10 years, and these are the numbers that I think I can attribute to it, or at least, get in the ballpark. And then I'm going to think about all the taxes that would occur if it's in my personal finances, and I'll think about all the taxes that would occur in a traditional, and I'll think about all the taxes that would occur in a Roth, and you just add them up and compare. Now, I realize that it's a pretty big task and it's a little bit far-reaching, but if you're in a position to step back and make this analysis, it can be very powerful, because what you're considering is, how do I pay the least gross amount of taxes over the life of this asset? And of course things can change, and it's maybe unlikely that all your predictions would come true, but it will give you a sense of how the different tools would interact. And so I totally think that this is one of those deals where you might think the answer is going to turn out one way, and once you write it down, it may end up, when you see the numbers, it may end up another way. So I certainly encourage you to do this, and I've seen our account holders do it with great effect. So if you have not contributed to an IRA, think about the whole picture if you have the time and ability to do that. Now, if you've already contributed to a tax-advantaged account, your analysis becomes much more limited, because there's a 10% early withdrawal penalty before 59.5. And so if you're not there yet and you don't want to take that 10% hit, which is, significant, really what you're starting to think about is, that money that I've contributed, how do I get that money to make the most money? It's no longer, should I invest in real estate in my IRA or outside? It's, if that money is already in my IRA, should I buy stock with it? Should I buy real estate with it? Should I give it to Kevin to go to Vegas? Whatever you're going to do with it, that's really the decision where you are then. You want to get that money to make the most money. So it's a different analysis. Now, it has some of those same elements, but a different analysis. And one of the reasons I mentioned all those account types is because the IRS actually lets you make some of that money portable. Those accounts can often be put into each other. So, you know, self-directed IRA companies, or all IRA companies, decide what they handle. So whether that's real estate or stock or whatever it is. So the idea is that you may be able to look at all the accounts that you have, decide on some amount of money that you want to invest in real estate or some other alternative asset, go to a self-directed IRA provider and say, okay, well, I'm going to do this combination of transfers and rollovers and get this money in position to go out and buy some real estate. So again, in that analysis of you've got the money in there, it's got the tax advantages attached to it, how do I get that money to make the most money? If you have a good real estate team and know some people that are educated about it, you like your realtor and your lenders and all that kind of stuff, then this is often the way that people go. And the cool thing about it, I think from my perspective, is that almost every asset and strategy that you might use personally or know about personally can be adapted and fit into your IRA. So you don't actually necessarily have to develop a new expertise. It could be commercial or residential, single family, multi-unit, it could be ag land, it could be land speculation, fix and hold, fix and flip. You don't have to have the full purchase price. If you're using auctions or short sales or foreclosures, those are all available to you as well. And leveraged or unleveraged, so an IRA can get a loan in order to get a property, and it has to be non-recourse, which I can go into detail at some later date because it has to do with disqualified persons, and we're not going to hit that tonight. But many lenders will do non-recourse loans, including Pine Financial in their hard money loans. So it could be a hard money non-recourse loan that lets your IRA get a hold of a property without having to have a lot of cash in it. So again, that's entirely up to the account holder and what they're comfortable with and the tools that they have and the expertise. But again, pretty much any of your real estate assets or strategies that you like, you can employ in your IRA. And
I've got a question for you right there, Clay, if you don't mind.
Yeah.
Nobody's asking questions yet. I'm sure they're coming, but I'm going to be teaching a class down in Colorado Springs tomorrow night about lease options and how to buy property with no money down. Can you do no money down transactions like lease options in your IRA?
Lease options you can. Yes, the IRS wouldn't restrict you from doing that. Typically, it's the other participants in the deal that'll want some skin in the game, but from an IRS perspective, if the IRA holder can wrangle that deal, the IRS will let them do it, sure.
I do get that question from time to time. I think it's very interesting. You could do deals with no money down in your IRA, and all the profit gets the tax advantages or benefits of that IRA.
It's amazing, right?
Pretty sweet.
Yeah, and I'll tell you the key thing to think about there is really titling. So because the IRA is going to be the actual participant in the deal, you need to make sure, whoever the account holder is, that all the paperwork that's associated with the IRA's participation is in the name of the IRA, not their personal name. And the one restriction that I do see sometimes is, of course, is that the IRA holder can't provide services or do sweat equity and that kind of thing. So if that's part of the deal, that can be a little bit of a thorn as well. But generally speaking, from an IRS perspective, as long as it's the IRA that is the financial participant from word go, again, pretty much anything that you can engage in outside your IRA could be inside. So, yeah. Okay, so ownership types, and this is really just, again, part of the things that your IRA would buy. We've mentioned the fact that the strategies can be almost anything. So your IRA can be the title holder. It is a legal and financial entity. It has money for purchase, and it has a name, and that's the way that paperwork goes. If it doesn't have full purchase price, it can be tenants in common on a property. And the other investors could be another IRA or a person or a company or a land trust. Almost any other participant can be tenants in common with an IRA. An IRA can be a lender if it chose to do that. and it can also invest in an entity that's investing in real estate. And meaning most often an LLC, but it could be an LP, C Corp, anything but an S Corp. And so lots of times that's how an IRA is collecting money, an entity is collecting investors, and an IRA can be one of those investors in an LLC or something like that. And the base operation of that LLC can be pretty much anything. So it could be a lending-based LLC. I think you guys have one of those, Kevin. And but it could also be an LLC that goes out and buys property, or I mean, pretty much anything. Again, it really is amazing how wide the playing field is there. Okay, so we're going to take a little bit of a turn here, and I'm going to try to wrap up both the personal versus the IRA, and then I'm also going to segue into the taxes that do occur inside an IRA, which is unrelated business income tax, because that's also part of the equation. It certainly affects your return on investment. So just to be clear about all that stuff, I'm going to just put it this way. So if on the left-hand side of the screen there is your personal financial world, and every year you have to file your taxes. On the right-hand side is an IRA, and on the far right-hand side is going to be an IRA that incurs some UBIT by virtue of what it is investing in. And UBIT is unrelated business income tax. It's just a cost of doing business, but it's important to calculate, right? So on the personal taxes side, if you're a real estate investor, you're obviously filing your 1040, maybe a Schedule E or others, and you're thinking about depreciation to defer taxes. You certainly want to take your expenses. If you want to trade up in properties, you might do a 1031 exchange. I've certainly seen people use corporate entities and trusts and things like that as tax shelters as well. It's beyond my expertise. It's not, and I don't give legal advice, but I definitely see account holders who are contemplating that with their financial team. So all of those tools land in your personal finance world. So you have some tools there in order to hopefully pay as little tax as you can get away with, which is, I think, is everybody's goal. Now, an IRA that is not incurring UBIT, and I am going to get into the specifics of when that occurs, really doesn't have to file an annual tax return because of its tax-deferred status, right? And none of the earnings in the IRA are going to affect your personal taxes from a year-to-year basis. Again, it's only contributions and distributions that really start to get into that consideration. However, if the IRA is performing in or has one of the investments that does incur UBIT, then there are some things that you need to think about. One is the IRA itself actually files a tax return. It's not a 1040, it's a 990T. And typically speaking, that IRA has to get its own tax ID number. I know I had to do that for my debt finance real estate that's in my IRA. So it gets its own tax ID number, it files its own tax return, and that's how it takes care of that cost of doing business. Now, because UBIT is based on net profits that are associated with the IRA's investment, there is a place here where you can take depreciation and expenses. You can even do a 1031 within your IRA, and I've certainly seen people engage corporate entities as a subset of their IRA. So all of these things might be a way that tools that you're engaging so that your IRA also pays as little tax as it can, so that the returns in that tax-deferred state stay as big as they can. And I do realize that there's a conceptual hitch sometimes when I say, hey, the earnings in your IRA are tax deferred, and then I say, oh, well, however, you might have to pay UBIT. So I think it's valuable to just think of UBIT as a cost of doing business in the investment type that you are engaged in, and that the profits from that from that investment are still going to be tax deferred, but there may be some UBIT along the way, and we'll talk about that in detail. But even if all of those machinations are occurring, with your IRA dealing with UBIT, it still doesn't affect your personal taxes, right? It's the IRA's taxes, not your personal taxes. Okay, hope that's clear. Okay, so when does UBIT occur? Let's get this out of the way. There's two things. If your IRA owns an ongoing business entity that is not paying business tax, then your IRA may have to pay some UBIT. If your IRA buys a property and uses debt financing, it likely will also have to pay some unrelated business income tax. And I'm going to talk in detail about how that works. But those two scenarios are the broad brush investments that your IRA might make where it would have to pay some UBIT along the way. And just to get our terminology straight, so UBIT is unrelated business income tax. It's the actual tax. And it results from two things: unrelated debt financed income, that's when your IRA buys a property with debt financing, and unrelated business taxable income, that's when your IRA owns an ongoing business that is not paying business tax as part of the entity. And again, it is funny because unrelated business income tax, it sounds bad, and sometimes people are afraid of it, and certainly there's a lot of financial professionals and tax professionals that are not terribly well versed in it. But it is just a tax as a cost of doing business. It's super niche area, can sometimes cause some confusion, but understand that the IRS is not upset about it. It's just a detail that has to take place with these certain investments. So there's nothing prohibited about it. It's not a penalty. There's nothing bad. It's not going to trigger anything different in what's going on in your financial world. It's really just a part of the investment. But let's look at so I'm going to go into debt financing first and look at the advantages. So if you've contributed $150,000 to your IRA and it buys stock, it has $150,000 worth of stock. If it buys a piece of real estate, it has $150,000 worth of real estate, both of which are awesome. But if you're comfortable with debt financing, you may be able to get a much bigger, more expensive property that presumably will yield more money back to your IRA. It's actually one of the only ways that the IRS will let you make money for your IRA and within your IRA using money that you never contributed. Because in that scenario, the contributions were $150,000, but the $250,000 came from totally outside your IRA. Some people will choose a different strategy. They'll take whatever they've contributed and they want to get a hold of as many properties as possible as fast as possible. And so they'll split it up and they'll get non-recourse loans for all of those properties. So that's just, again, it's the account holder strategy, what they're comfortable with. A lot of times it has to do with how old they are, when they're going to want payout and things like that. So it really is a part of, it's very idiosyncratic, and it goes to, your entire financial world. One of the things that I always like to point out in a tax scenario is this too. So if you think about those 150,000s on the 2 slides ago and how that got contributed, the fact of the matter is, in a traditional, if you had not used that tool, it's possible that the taxes that you would have paid on it might have brought you down to, I don't know, 100,000 or 120,000 or whatever it would be. But in this way, the IRS is actually kind of your friend because of the way that the tool works. If you earned 150 grand and if you invested that 150 grand in your personal finances, you wouldn't be able to spend the whole 150. So it really does have some tax benefits that can be advantageous, and it's hard to think of the IRS as helpful, but in that particular case, it works pretty well. Okay, so as I mentioned before, we're talking about the debt financing variation of UBIT first, and I'll say that it's only on the percentage of net income that's attributed to the debt financing. And I'll talk about that in detail, but if the outstanding debt percentage in a given year is 50%, then only 50% of the money that comes in is going to be even considered for UBIT, and you get to take the gross proceeds and knock them down to a net before you calculate the actual tax that's going to be paid. Those deductions can do include depreciation, and interestingly enough, there is a way in IRA land, not in your personal finances typically, but in IRA land, where you can take deductions for depreciation for many, many years, and then there's a way that UBIT's calculated that will allow you to sell that property and never have to pay tax on the depreciation that you claimed for all those years, and I'll get to that in a few minutes. The UDFI would occur at rental income over time, but it also would occur at the sale of the property. So both of those two occurrences could trigger some unrelated debt financed income that you would have to pay UBIT on. Okay, so let's talk about the rental income first. So my IRA owned house got $10,000 gross rental in a year. All of that money goes back to the IRA first, and because my IRA has its own tax ID number, it's going to file a tax 990T. And in this particular case, and again, I'm oversimplifying this a little bit, but the sample calculation is going to be that there's 60% outstanding debt. So 60% of that 10 grand or 6 grand is going to be considered for UBIT, but 4 grand of it will not, because that's money that I contributed to the IRA, so it is actually has the full tax benefit. This money that I brought in from the outside doesn't have the full tax benefit because I never went through the rules to contribute it. So 60% is going to be considered, and I'm going to just arbitrarily say that $2,500 is 60% of that property's expenses and depreciation, so I knock that off. You get $1,000 free from the IRS each year. So now we're talking about $2,500 that would be taxable unrelated debt financed income, and that is taxed at the trust and estate rate. And I picked 2014 because if you've ever seen the trust and estate rate, it's just a little chart, and it can change from year to year. So I just went back and did the 2014 one just as an example. So if I threw $2,500 up on that chart that is the trust and estate rate, I got $375 that my IRA needed to pay the IRS. So what that means is that of the 10 grand gross of a property that I got by financing, I had to pay $375 to the IRS as part of expenses. I also have to pay interest to the lender and so on and so forth. So all of this is part of the calculation. But in a lot of cases, depending upon the property, if you run the numbers, you can see that even if you have to pay UBIT, the investment is still worthwhile. So in this particular one, again, this is an arbitrary example, but $9,625 got to stay in my IRA. And it is important to note that all the proceeds come back to the IRA first, and then the IRA pays the tax. Okay.
Clay, I got one question here. Do you want to cruise through this since we got a little bit of a later start and take the questions at the end, or would you like me to ask you as we go?
Why don't we go to the end just in case if somebody needs to tune out, then take off, then they can.
Okay. So you guys have your questions. Go ahead and put them in the questions, and we'll take care of all of those when Clay's wrapping up with this presentation.
Okay. So UBIT that might occur on a sale of the same property, right? So let's say my IRA bought it for 100 grand, I sold it for 150 grand, and at the time of sale, the outstanding debt leverage was 40%. Now, the way that the debt leverage percentage gets calculated is that it's an average of the previous 12 months of debt percentage, meaning that because your IRA is paying debt service just like any other real estate investor who has debt, they are going to, your debt percentage is going to change month by month. So the way that the IRS calculates this is by taking the previous 12 months and averaging the debt percentage. And the reason that that's important is because we'll talk about the depreciation part in a minute here, but that's the way that this 40%, and I obviously made it a nice round number, which is unlikely, but that's the way it gets calculated, average of the previous 12 months. So I bought it for 100 grand, I sold it for 150 some years later, and over that time the depreciated value of the property was, let's just arbitrarily say 30 grand. So, and at the time of sale, I'm saying that the outstanding debt is 40%. So, we're talking about how do we calculate UBIT on this $80,000 spread between the depreciated value and the sale price. So, and there's two pieces to it. So the depreciation part, literally what you would be doing is going back to your 990Ts from the time you acquired the house to the time your IRA sold the house, and you would just be saying, okay, well, this is how much depreciation I claimed over time in service of my 990T UBIT calculation. So it's impossible for me to say exactly what that is. It certainly wouldn't come out to be 40%. But that 30,000 is not what you would be paying tax on. It is some fraction of that 30,000, and it would be the sum of all the depreciation that you took in previous years. Now the 50 grand that's above would have the 40% part calculated in. So of that 50 grand, only 20 grand would be considered for UBIT because there's only 40% outstanding debt leverage at the time of sale. And that would be taxed at either short or long-term capital gains depending upon how long it was that my IRA owned the house. Very similar to the way it would be outside of an IRA. So there's two different tax rates, or three actually. So shorter long-term capital gains on that top part for the 50 grand, and the depreciation gets taxed at the Section 1250 rate, which I think at the moment is 25%, but as you know, all those things can change to some extent. So those are the two. I'll go back to this just for a sec. So those are the two places where UBIT might occur if you have debt financing on an IRA-owned piece of real estate. Now I'm going to move over to if your IRA owns an ongoing company, and included in an ongoing company would be if your IRA is a fix and flip operation. So if your IRA is doing fixes and flips, then that business part would either have to pay business tax at the entity level or would have to pay UBIT at the IRA level, and I'll show you how that works. For ease of understanding, let's just call it ABC Corp, and let's say it owns a lumber yard. So ABC Incorporated makes some income, calculates its business tax. It's a C Corp, so it's calculating its business tax, and then its investors get their money, right? Typical sequence. Now let's say that the IRA owns the same lumber yard in an LLC, which in most cases is a pass-through tax entity, so wouldn't be paying the business tax right off out of the income. So the income comes in to the IRA, and instead of paying business tax, it's paying business tax by virtue of the unrelated business income tax. So the IRS is trying to level out the playing field so that your IRA can't outcompete every other lumber yard. And then the IRA gets to keep whatever's left. Now the actual sequence of the money, of course, we talked about this, the income would all come back into the IRA, then the IRA would calculate what the UBIT is and pay that amount to the IRS. So as you can see, the difference here is between the business tax that a C Corp would calculate, and if the entity that runs the lumber yard is pass-through, so no business tax, that business tax gets taken care of at the IRA level. So what that brings to mind is, from a tax strategy standpoint, is thinking about what would your taxes be on that lumber yard if your IRA owned a C Corp in the middle, so the business tax would be taken care of at the entity level, and all of the remainder would come back to the IRA, or would you pay less taxes doing UBIT, so having all that money come into the IRA, filing a 990T, and calculating what the unrelated business tax would be. It is at the trust and estate rate, but depending upon how much money the lumber yard is making, one of these may show itself to be a tax advantage. So that's one of the things to think about in terms of how you set up your IRA-owned ongoing business. The other thing to think about is that because of the way that UBIT is applied, so debt financing or an ongoing business, you may need to think about the way you want your IRA to trade in something. So if you want to get some money to a company to quote-unquote invest in a company, if you make a loan to that entity, there's no UBIT calculation because that's one of the exceptions in the code. It's considered to be passive. But if your IRA makes a private equity or a private stock investment in that company and its return is dependent upon the performance of that company, then UBIT might be possible. So if you want to avoid UBIT, you might make your participation lending based. And certainly, when you're talking about real estate, you don't have to use leverage. And if you don't use leverage, then you would not incur UBIT unless, of course, you're an ongoing fix and flip business or something like that. So again, in terms of strategy and what tax you'll pay and how you calculate it and at what rate, sometimes the ownership that your IRA is choosing to have can affect your overall gross taxation with regard to that asset. And so, again, you can obviously avoid UBIT if you own an ongoing business and you have a C Corp in the middle that would pay the business tax, and you would end up not having to pay UBIT because the business tax would be taken care of. You don't have to leverage your property. Now, I want to go back to this depreciation thing just because I think it's cool. But if your IRA owns a property and uses debt leverage, obviously you're going to be calculating your UBIT each year, right? And in that calculation, you're going to be declaring some depreciation, which is a deferral, of course. But because of the way that UBIT is calculated, or the debt leverage percentage is calculated, where it's an average of the previous 12 months, if you pay off the debt service, either through time or other investments paid off in your other IRA or even in that IRA, you pay off the debt and wait 12 months and a day, then the average of the previous 12 months is 0%. And so whatever the sale proceeds are at that time would not have any UBIT calculation because the debt leverage percentage is 0. So while depreciation in its garden variety form is just a deferral, in that particular case, you never have to go back and pay tax on the money that you deferred through the depreciation. So I think that that's a pretty cool thing. And if you want to get really geeky about it, which I typically do, you can actually do a 1031 exchange within your IRA. So if your IRA wants to trade up properties and it has outstanding debt leverage, you can do a 1031 exchange to defer the UBIT, right? And if you do that over a number of years, let's say you traded up properties 3 times over 20 years, and all those 20 years you had renters in there, so you were taking some depreciation every single time. Even then, at the end property, if you pay off whatever the debt is at that time, wait 12 months and a day, again, you never have to go back and pay tax on the depreciation that you deferred all those years. So it's one of the unusual benefits of the way that this particular system is set up. And I think it's always cool to have a way to beat the IRS, but that's just me. Okay, and then the last one I'll just say is that, and this happened with my property, my IRA owned property as well. If you're using debt leverage, you definitely want to file the 990Ts, because if you calculate that you have a net loss in the beginning years, which happens a lot, you want to bank those losses because you can use them to profits of that IRA-owned real estate in later years. So getting ahead of the UBIT part is an important thing. Okay, so a couple more strategy things and then we'll wrap it up. All right, traditional to Roth conversion. So part of the reason that we were doing this webinar is to talk about the tax tools, or the way to use those tax tools to your advantage. So obviously, if you have money contributed to a traditional IRA or a SEP or a 401k where it's pre-tax money in, you may have the opportunity to make a conversion. And at this particular time, conversion rules are very liberal. You can convert as much as you want. There's no restriction on your income. There's no restriction on the amount you can convert. It is a taxable event, of course. You're moving the money from quote-unquote pre-tax to post-tax. And so whatever gross amount that you convert ends up being on your personal income tax in that year. So this is an additional way that your IRA can affect your personal income tax in a given year. So contributions, distributions, and or a conversion. There is a 5-year rule for all Roth IRAs. In order to make a qualified distribution of all the assets in a Roth IRA, it has to be open for at least 5 years. And when it comes to conversions, each time you make a conversion, a new 5-year clock starts. And the distribution rules for Roth are surprisingly complex in some scenarios. So if you have questions about that, just let me know. But the thing that I see in terms of people using this tool, there's a few things. One is total tax analysis. So sometimes people will, and this is the 4th bullet point down there, sometimes people will, if they are going to invest in something that has a possibility for a very high return in comparison to how much they invested, so windfall, high risk, high reward kind of thing, they will make a conversion to a Roth first, because if the 10,000 you put in there yields 90,000 in earnings, then the tax on the 10 grand is obviously, well, in most scenarios is going to be much, much less than tax on 100 grand. So if the earnings have the potential to be very high, sometimes people will go to the pain of making a conversion ahead of time so that all of the earnings can end up being tax-free. Now, I talked earlier too about the time consideration. So if you want to take speculation out about tax rates when you're retired, about how much money you'll have, how much income, if the government is going to raise tax rates in general, any of those things, that's sometimes why people will do a traditional to Roth conversion as well. There are a few others. So if you have in your personal taxes, if you have a loss on an asset in your personal taxes, in your personal world, and that means that your tax burden for that year is going to be a little bit different, you may take that opportunity to make a conversion from traditional to Roth because your net tax for the year might end up being kind of equivalent. So taking advantage of what's happening in the rest of your financial world is another thing that I see account holders do when they take into account whether they want to do a traditional to a Roth conversion. And of course, at this point, without any restrictions, some people also just do a little bit at a time according to how much they can handle. One of the last things that I see account holders doing with some frequency is that in a traditional IRA, when you hit 70.5, of course, you have to start taking required minimum distributions, or RMDs. If you've done well and the rest of your financial world is working out well, and you don't want to start to get into required minimum distributions, maybe because you want to use your IRA as a generational wealth tool or something like that, you certainly can make a conversion, even in your 60s, 70s, whenever, from traditional or Roth. And Roths do not have required minimum distributions, of course, because the IRS has already gotten their taxes. So this is some of the ways where I see this tool engaged by account holders to either serve their personal financial preference or to mitigate or minimize the tax event on a particular asset. So let's talk about distribution strategies. Hey Kevin, you're not going to believe this, but I don't have a clock in here. How am I doing on time?
We probably should be wrapping up right now, so if you want to cruise through the last few slides that you got.
You got it. So one of the last things I'll just mention is that distribution strategies are important because you can take distributions from your IRAs either in cash or in kind. So that means if you have hard assets in your IRA, you can distribute them in kind. And also I'll just run through this really quickly. You can see that if there's cash and assets in an IRA, you can start to really think about your age and whether you have required minimum distributions in terms of the strategy that you pick for taking distributions, right? So again, learning the rules and knowing what they are can definitely affect how you do a distribution strategy. And you can obviously, I said, take an in-kind distribution, which is the physical thing, but you don't have to take the full tax hit in 1 year. You can distribute even a physical asset in percentages. So that would obviously spread the tax burden out over a number of years. RMDs we talked about, so I'm going to blast past this. And the last thing I'm going to talk about really is beneficiary basics. So an IRA does name beneficiaries, and because it does that, and because of the way that IRAs are set up, it generally speaking bypasses probate, and so people do use this as a generational wealth tool. It is important to make sure that you have the correct beneficiaries updated on your account. But beneficiary IRAs have some unusual rules, and if you have questions about them, just let me know. But it has some ability to have the tax advantages spread out over the beneficiary's entire lifetime, at least up to this point. There are certainly ways that you can utilize Roth distributions and the gift tax rules to get money to your family in the here and now as well. And one thing that a lot of people don't know is that you can actually disclaim inherited assets. And this is really, again, it's a kind of a complex family type generational wealth tool, but the first beneficiary can disclaim their inheritance, and it'll pass on to successor beneficiaries, and that may be your kids or somebody that you want to funnel the money to. So depending upon what your financial world is, there's some tools when it comes to beneficiaries as well. And that's really the end of the slides, and I apologize for my technical difficulties at the beginning. One last thing I'll just mention is that, today we were talking about some pretty detailed tax rules and tax rates and things to consider when you're setting up your IRA. And so this was a pretty specific presentation. If you are looking for an overall education on self-directed IRAs and things like that, we do have an event coming up in the Denver area on October the 1st. You can see it there on the left, Real Estate Fast Track Summit. And I'm happy to answer questions with Kevin for a while. And if you have questions that come up later, of course, feel free to email us or give us a call at the office. We're happy to answer those or help you out at any point.
Okay, I'm going to go ahead and I got a couple comments here, and then I'm going to go through these questions that we're getting. You were talking about UBIT and how it scares people, Clay, and one of the comments that you made that I thought was humorous was that the IRS does not get upset about UBIT. They don't get upset about collecting taxes anywhere, do they?
Turns out not.
So I thought that was great how you did that. I also really like how you can pay off debt, wait 12 months, pay off the debt, wait 12 months, and then sell the property and not pay any tax on any of the appreciation that the debt helped you create, basically. That's pretty amazing when you went through that. So let's go through these questions. The first one I'm going to answer because it has to do with the recording. I am going to try to get this up on our YouTube channel in the next couple of days if the recording quality is high enough. Sometimes we have a little bit of trouble with these recordings. So if it's good enough, I'm going to definitely get it up on YouTube, so keep a lookout for that. And then we're going to come back to required minimum distributions, Clay. I got two of them here. I'm going to paraphrase this one. The question has to do with if your money is tied up in your IRA and you have to do, or your money is tied up inside your IRA into real estate, so it's not liquid, and you have to take required minimum distributions. Do you have any strategies or ideas to help her out?
Yeah, there are a few things to consider. First and foremost, if you have other assets or other IRAs, an individual's required minimum distribution it's a personal number that gets arrived at. So, and we have lots of account holders that still have an IRA at Schwab or Fidelity or someplace like that too. So you can pay your entire required minimum distribution out of any one of your IRAs. So if you have some, or any one of those assets. So if you have some assets that are liquid and some that aren't, understand that you don't have to take the same percentage of each asset. You just have to satisfy the number for you personally. Secondly is just, if all you have is hard assets, I do think you're in a position where you have to start taking stock of whether you want to liquidate that asset in order to distribute cash or take in-kind distributions that you can handle the tax burden on, because in-kind distributions do satisfy required minimum distributions. So that can be a little bit more challenging from a practical standpoint, but your hard assets can be distributed in pieces to satisfy your required minimum distributions.
Okay, or hopefully there's some rental income that can help with that as well.
Right, right.
Okay, if you, what does it say here? If you have to do required minimum distributions, how is real estate in your IRA valued?
Yeah, it's a great question. So every asset in your IRA has to be valued every year. So stocks and mutual funds are pretty easy because the marketplace is so established. And with hard assets, particularly real estate, if there's not a taxable event in a given year, we generally, and this is provider specific, we generally will take a broker price opinion or something like that, even sometimes a tax roll record, to do the ongoing annual valuation. But when you start to get into years where you're going to have a taxable event from a required minimum distribution, typically at some point we'll ask for a formal appraisal of the real estate. Now, if you're on an ongoing required minimum distribution schedule, in other words, you're taking X number of dollars each year, we would not require an appraisal every year. So sometimes it depends on how much you're going to take out and how long you're figuring to put yourself on a schedule for. We try to make it as painless as possible, but there's going to be an appraisal in there somewhere, just so you know.
Okay. This one's a pretty specific one, Clay, so if you can't answer, just let us know. But the question is, if she has a thrift savings plan and a Roth IRA, and she's looking at purchasing some rental property or some investment property is what she says. What would you recommend in regards to financing this investment?
Well, so let me just map the options. So the thrift savings plan, depending upon whether you're still employed there or what its portability is, that may or may not be able to be put into position with a self-directed IRA provider that handles real estate. If it is, you could certainly, roll it into a traditional and have the traditional and the Roth be tenants in common. So if you have the full purchase price with the two accounts, you can do that. Some non-recourse lenders will lend to two IRA accounts if it's the same person, and sometimes even if they're spouses. So you could presumably, if you had both of those accounts as participants, you could go to a lender and see whether they're willing. The IRS will let you. It's just whether the lender will let you. So, ask lenders around, and we've seen all kinds of deals made, but so that you could be partners that way. The two accounts, again, if it's allowed from the thrift savings plan perspective, those two accounts could invest into a private equity deal, into an LLC that they created for that very purpose, so that there's just one entity, and then that one entity could go to a lender, or if it has the full purchase price, it could go from there. So there are some structural ways that you could handle that, and you wouldn't necessarily have to, convert. But if you wanted to, and you wanted to get everything into a single account, you could presumably, again, this is if the thrift savings plan is mobile, convert that to a Roth. So you would have all of it in a Roth as well. So you do have some options. So the first thing I would investigate is the thrift savings plan. If you're no longer employed there, typically that will be mobile. If you are, you need to ask them whether there's any provision for getting the money in position somewhere else.
So if somebody has a real specific question about their situation, Clay, I know you guys do a lot of education like this. Do you guys do like consultations, or how does that work if someone's got a specific question like she has?
Yeah, we do. So there's a couple things you can do. Our website has a consultation feature on it, so you can actually just schedule it online, and then we'll meet you on the phone at the time that you pick. That extension 155 that's up on the screen is staffed by folks during our business hours who are happy to handle very specific questions. And my extension here is 113. So if you guys have a question on something that I talked about today, maybe I'm the best person. But we have, those phone options. And then, like I say, if you want to schedule a consultation where it's just, a dedicated amount of time that you schedule, you can do that online.
Okay, here's a question I think is actually a good question. As much as we talked about financing real estate today, Clay, I don't think we actually covered this, but if the real estate is financed, how is the payments made and factored into your taxes? So how are the payments made and factored into taxes?
Sure. So the IRA basically receives all of the income, so presumably the debt service is paid out of the rental income, so the rent would come back into the IRA. It would be in the IRA's cash position, and then it would have to be dispersed monthly to pay the debt service. So a very similar system that it would be outside the IRA. It's just that the cash position is here with the IRA. And certainly, with us, we can do it electronically, but it's the IRA, because the IRA paid for the purchase and got the loan. It's all in the name of the IRA. It's going to pay debt service just in a very similar way that you would outside an IRA.
Okay, here's another good one, I think. Anthony asks, he's talking about rental properties in your IRA, and you're producing cash flow from the rents. What happens to that cash flow? Where is it held, and what can you do with it?
Mm-hmm. So kind of similar. So anything that the returns that any of these investments make come back into the IRA. Because it's still all in that tax-deferred umbrella. Now, once the cash hits the IRA, the account holder is in total control of where it goes next. So you can hold it as cash until you have enough to buy another piece of real estate. You can invest it in something else, make a loan. So as soon as the cash is in the IRA holder is really, again, strategizing how to make that cash go to work again. and
When you say
that's
cash, like you mean like a money market type of account, right? So it
well
is
in
earning
our
some interest, or what do you mean by that?
yeah in our particular case it's not money market, it's static. So it's literally just an FDIC insured bank account. So if the bank failed, it would be insured, but it's not making any money. So one of the things that self-directed IRA account holders have to do is be thinking about how that money gets deployed so that it is working. Yeah.
Okay. It looks like that might be all of the questions, you guys. If I think Clay's going to stick around. If you have any more, please input them now, and we'll get those answered. So just wait just a minute here, Clay, see if any others come in.
Sure.
Great job, by the way. That was a pretty advanced webinar. I haven't seen you do one quite like that before.
Yep. I did it just for your audience, Kevin. Well, one of the things, as I mentioned at the beginning, is that, you know, because I know your organization and you work with some sophisticated folks, I really wanted to get down to some of the nitty gritty, even if it wasn't totally absorbable, 100% on a webinar, at least to get people thinking about the moving pieces. So I appreciate the opportunity to do that.
Yeah, it looks like we have one more, Clay. And you know what? I really appreciate you doing this for us. Sometimes it's hard to get your time, and you gave that to us here tonight with outside of normal business hours. So I tell you what, I really appreciate that.
You're welcome.
So when I say Victor is asking, how does the IRA buy the LLC?
Yeah, that's a good question. So one of the investments that is allowable for an IRA is to purchase private equity or private stock. So if an LLC is either in existence and selling some of its ownership, or gets created and the organizing document says that the shares can be purchased for, the ownership can be purchased for X dollars, the IRA, well, the account holder will come to us and say, hey, I want my IRA to buy whatever percentage of this LLC, ABC LLC or whatever it is. And we would say, okay, well, get us the operating docs and a few things to just substantiate what you're buying. But the IRA would literally cut a check that's made out to the LLC, and what we would keep in trust and in holding for the IRA is the documentation that says that money we dispersed entitles the IRA to whatever that percentage of ownership is. Now, once that money is at the LLC level, because an LLC is also a legal entity, then that LLC can go out and do what it's going to do, whether that's buy and sell houses or make loans or, again, send the money to you so you can go to Vegas, whatever it is. So the LLC then is autonomous to some extent. It has to value itself each year, just like we were saying all assets have to be valued. But what the IRS sees and what the IRA provider sees is that your IRA owns a private equity stake in whatever that LLC is, and it's this percentage or this number of shares.
Okay, good. Yeah, I know for our mortgage funds, we do it just like you described with membership units, and people are coming and going out of our funds, so the percentage changed, and the value of our units always stay the same. So you earn interest on that, and you just end up buying more and more units. So the IRA buys into the LLC they buy into the LLC by buying, wow, say that fast, membership units instead of shares like you would in a corporation. So I think that's, go ahead.
Hey, Kevin, I was just going to say one other thing to kind of tie that together. I'm glad you brought up the fund. Is one of the things that I think, going back to the question about having the cash proceeds or the investment payoff being redeployed to be making money is, real estate, because that's kind of our world. I talked about that pretty specifically today, but there are lots of ways to participate in real estate that are more fractional and have a much lower threshold. And so, there really is and I've seen a huge boon in this, not the least of which is your guys' stuff, but where people do have some, a low threshold to get in, and some flexibility in terms of how they get out, and that's asset specific, of course. But I do think that real estate investors should know that there are ways to redeploy that cash and to keep it working without having to necessarily come up with 50 grand or 100 grand again to buy another house. So I'm glad you brought that up.
Yeah, I'm glad you just said that as well. It doesn't take a whole lot of money to get going here. I guess that's the point. So with that, Clay, I'm just going to again say thank you so much for participating in this with me tonight, and I want to thank everyone that's still on the call. It looks like about half the people stayed all the way to the end. We really appreciate that. Remember to stay current on all of what Pine Financial Group is doing at pinefinancialgroup.com. If you're interested more in what Clay is doing, newdirectionira.com. And I guess this is the first time you've done of an event like this, the Real Estate Fast Track Summit, for those of you that are in the Denver area. So definitely look at newdirectionira.com and check that out. And I hope everyone enjoys the rest of your night. Thanks again.